Welcome to our panel, Institutional Case for Digital Assets. I'm honored to be here with our exceptional lineup, and let's just jump right into the bios, and then we'll get to the good stuff. So to my left is Jared Klee. He's a product manager for IBM Blockchain, responsible for tokenization. Jared serves as a trustee for the Williams School and class officer for Dartmouth College, from which he holds an AV degree. Next is Michael Sonnenshein. He's a managing director for Grayscale, which is the largest digital currency asset manager with over $1 billion in assets under management. Prior, he was a financial advisor at JP Morgan and an analyst at Barclays, and has his MBA from Stern NYU and bachelor's from Emory. Next to the left is Terrence Dempsey. He's a product manager for Fidelity Digital Assets. Fidelity Digital Assets provides enterprise-grade digital asset solutions for institutional investors. Prior, Terrence spent nearly 5 years as an operations lead for Grayscale's Bitcoin Investment Trust, GBTC. And Terrence is a BS in business administration with a concentration in finance from Marist. And last but not least is Cormac Kinney. He's the founder of Diamond Standard. They are creating a standardized diamond commodity that's transacted on the blockchain. And Cormac's innovations have been cited in nearly 4,000 US patents. He founded 4 startups that have been acquired by public companies, and has been a quant finance pioneer, inventing heat maps and managing $500 million for large funds, Tudor and Millennium. So let's just level set real quick. We know the panel is called Institutional Case for Digital Assets. Digital assets is a little bit of a vague term. Here we'll be talking about assets that where the accounting takes place, and sometimes the workflows take place on a blockchain or a DLT. And I think we'll probably be using those terms interchangeably. But Jared, let's start at the beginning. What is a blockchain?
What is a blockchain? So I think at its most basic, we've got this idea of we can have a ledger that's shared. And what do we mean by that? We can have a series of transactions between a set of parties. We can all agree on the history of what happened, and we can have this idea of it being immutable, meaning we can't change, or at least it's detectable if it is changed. So what's interesting is if we break that down, I'd actually look at 2 different things. So first, I'd look at blockchain's not actually new. You've got a set of emergent properties around it, but the stuff that makes it up, the core components, have actually, for the most part, been around a long time. So you have this idea of private-public key cryptography. It's at the beating heart of how the internet works. You got this idea of hashing something. So, again, that's been around 30, 40 years, the math behind that. What's been interesting is when we combine a number of these components, a shared ledger, encrypted data, so on and so forth, we get these emergent properties. Among the more interesting ones are, one, we can have this idea of quote-unquote distributed trust. So many parties who may not necessarily in today's world having separate copies of the world, instead we can have a shared copy and agree on what happened. Second idea is we can solve for delivery versus settlement, which we'll get into in a various set of use cases, but programmatically, we can ensure that both sides of the trade go through or neither of them go through. That's particularly powerful. We'll get on to a couple others, but what's very interesting here is as we talk about that ledger, we can write both data, meaning I did something, you did something, et cetera, and agree on that history, as well as we can create data that represents value, say stocks or bonds or what have you, and we can agree on, 1, what those things are, and 2, who owns them at a point in time, 3, the ability to trade them without an intermediary.
Great. And Terrence, next question's for you. So we generally know what institutional means, and Fidelity recently surveyed and released the survey results of asking about digital assets and institutional investors. So specifically talk about what institutional means as an investor, and then perhaps talk about the results of the survey.
Yeah, absolutely. So institutional, and the terms here, and probably represented by everybody, runs the gamut of a registered investment advisor making investments on behalf of individuals or other clients, all the way through to your biggest pensions, endowments, and true institutional investor. And in the middle there, you have hedge funds, family offices, venture capital firms, and a number of other different types of institutions that are allocating in the space. And those 5 segments that I just mentioned were all big parts of a survey that we did at Fidelity from November of 2018 through February of 2019. So the peak or the bottom of the bear winter, or the crypto winter that we had, and the survey results were super interesting. 22% of 400 institutions are currently allocating to digital assets, and that could be holding it directly, that could be buying it through a venture fund, but they feel that there is a place in their portfolio. And the folks that found this type of investment interesting, of those 400, nearly 50% thought there was a place in their portfolio for digital assets.
Great. And I guess, Michael, this leads right into, say, Bitcoin as a digital asset. What digital assets are these institutions buying?
Yeah, sure. So I think everyone touched on some really interesting points of how institutions are thinking about the space. For us at Grayscale, being the world's largest digital currency asset manager, we're today primarily serving institutions. I think a lot of the institutions that we're interacting with are really looking at Bitcoin in particular as a digital store of value, and really thinking of it as digital gold. And so we've seen, particularly over the last, call it 18 months or so, quite a bit of inflows from institutions. About $360 million flowed into the Grayscale family of products last year alone. And we're also starting to see that institutions, in addition to looking at Bitcoin specifically, are actually being able to see that there are further diversification benefits as they start thinking about other digital asset exposure as well.
Great. And Cormac, there are other digital assets beyond just Bitcoin. Can you first speak a little bit about why blockchain as a base layer is important for a digital asset, and then tell us more specifically about Diamond Standard?
Well, the blockchain enables this reliable ledger to publicly keep track of who owns what transactions have been made, make sure there's no double spending. And that's essential in digital assets because you may think you own it, but the blockchain is the fact. And we've taken that and applied it to a physical asset, which is the Diamond Standard is the first fungible diamond commodity. We produce a physical coin and bar, looks like these are the bars that we've just launched, where every commodity we produce has the same total scarcity of diamonds. So it's just like a gold bar. There's one global price. We solved a challenging computer science problem, which is how do you make this fungible? And we did that by using the blockchain, tracking the provenance of a large number of diamonds. And we created a regulated diamond exchange where we source all these diamonds with a transparent bid. We're the first and only market maker in the world for diamonds, where we bid literally every day on 16 million different types of diamonds, and able to provide these bars with a standard content where we raise our bids to whatever degree is necessary to do that. The end result is, yes, it's physical. People, it's good for ETFs, for institutional investors, for individual investors. But what's interesting to the panel is that each Diamond Standard bar contains a wireless encryption chip that's built in, and that chip stores a blockchain token. And if you trade the token, you've traded the diamonds. And the blockchain provides that both the transparency and the ledger to prove that the asset is fair. It's absolutely verifiable by anybody, and that's only possible with the blockchain. What's interesting is, as a digital asset, this is physical. It is a token. It can be attached to any blockchain, and now physically asset back any type of smart contract with a store of wealth that can be delivered and decentralized. And it's interesting. It's never existed before.
Cormac, one of the things I really like about what you and your team have built is you've got two chunks of that. And we've got an asset class that couldn't have existed without blockchain.
Correct.
You've got, if we back up in the process, at some point those diamonds were sitting in the ground somewhere. And we can bring that supply chain on. Many parties, often across many jurisdictions, many countries. There's a long process that happens, and we can prove where those came from. So in the event we wanted to prove they were responsibly sourced and so on and so forth,
Exactly.
we can have the attestations from the individuals who touched that and say, I did this here, and I did this, and I handed off, and so on and so forth. And you have multiple parties who all agree, yes, I agree, XYZ party did that. And we're doing that with, actually we're working with a partner around the diamond sourcing. We're doing similar work in supply chain elsewhere in tracking the provenance of food. So obviously food spoilage, and we think of the E. coli breakouts. Very good example. What I love about where you've taken this is you've taken that supply chain process, you've taken the supply chain process, you attached it to the asset itself, and now you've got this history of the asset that leads all the way up to the point where it's originally sold, and now you've got that entire exchange going forward. So when we think about that for other asset classes, this is a novel one that couldn't have existed. But when we think about for, say, the private debt markets or, say, your venture capital markets, so on and so forth, we can take the entire history of the deal, the proof that you're an institutional investor, and so on and so forth, and append it to the asset itself, along with, if it's in later stages, fund performance, et cetera. And we get a much richer asset than we have available today, which over time we expect folks will build out your traditional algorithmic analysis, et cetera. So we get much deeper insight into asset classes, which today are a fair bit murkier.
So Justin, I wanted to jump in and just share that I think for the institutional community in particular, they've come to appreciate that digital currencies are in fact a bona fide asset class, and that they do in fact deserve a allocation to them as part of building out a diversified portfolio. Institutions are waking up to this for, I think, a couple of reasons. One, I think, is certainly that they're starting to identify a lot of areas where they already have exposure, and digital assets and digital currencies may start to affect some of those investments. Certainly, folks are looking at places like payments and value transfer certainly is a low-hanging opportunity where we're starting to see a lot of use cases come to light. But I also think that institutions are really beginning to drill into the uncorrelated nature of digital assets compared to other assets that they may own or have exposure to. And so when you think about what's the holy grail of investing, it's finding that uncorrelated alpha. And when you look at adding exposure to things like Bitcoin, you're finding really diversified return streams. And when sized appropriately for a lot of these investors, it can really enhance your risk-adjusted returns. And so the conversation with institutions went from kind of skeptical, probably about 18, 24 months ago, to now, the hedge funds and institutions that we deal with have dedicated teams that are spending time monitoring the digital asset space, becoming those internal champions, and ultimately are the ones bringing those allocations in front of the CIO and the investment committee, and ultimately pulling the trigger and deploying capital.
I would just add, I think the great thing about natively issued digital assets are a little bit different than what Cormac was just talking about, so things like Bitcoin, Ether, and others. There's 5 or 6 or 10 reasons why institutional investors want to get involved. The low correlation is one, the drop gold and store value reason is another.
Sure.
But whether you're a value fund, a macro fund, an arb trader, I think there's a lot of good reasons and rationale for why folks are getting involved, especially at the institutional level today.
Yep, sounds like a differentiated type of assets, right? So Jared, one thing that I hear a lot is that blockchain is still relatively unproven technology. On the main stage yesterday, we still heard how blockchains are slow, like 7 transactions per second is frequently quoted for Bitcoin. What innovations and what progress has been made, and what different types of blockchains exist to help support, say, scalability and even privacy of transactions, and what has IBM been doing in this space?
I think it's a fantastic question, and if we look at the world today, as we talk about Bitcoin and Ethereum, we have this idea of public permissionless blockchains. And But by those terms, public, we can have anyone participate. They don't need to identify who they are. You can impose that on top in some of the systems, but natively not. Permissionless, you transact, and so on and so forth. We have this idea of, at the other end of the spectrum, private permissioned. If we can put that as one, you declare who you are. So there's either a central or decentralized authority mechanism where you're forced to prove who you are. And then transactions, you've got almost a country club model where you can choose who can and cannot participate in that network. And you can get into various layers of maybe some of the players can see all of the transactions, some can't. They can only see parts of it. So you can imagine a regulator and auditor who participates on that might have a view-only capability and see everything, but individual participants, say in a GPLP structure, can only see the things that are relevant to their subset of the world. Where this gets really interesting is the question is, and with due respect to the panelists yesterday, I'm less interested in the breakdown of saying one's better and one's worse. Rather, it's a question of what is the problem you're trying to solve, and is this the right technology to help you? So if I take two very different examples of work IBM's doing today, we're working, I'll take three examples. One that's kind of data supply chain, one that's asset-based, but you need for regulatory purposes, a more limited scope, and one that's truly public and permissionless in nature. On the far end, we're working with Walmart and others, as I mentioned, on tracking food. In that case, Walmart and Carrefour and a number of their major competitors are working together to solve the problem of where does food come from and be able to track it and the status of it. What temperature was it at? How long was it there at each point in time? Clearly, the depth of supply chain expertise and the global nature of that is a competitive differentiator for these companies. But the problem of when E. coli breaks out and spinach gets pulled from everybody's shelves is a shared problem. So what we know is we need all of that data in order to solve it, but we only want to be able to share that at a single point in time. Namely, if we have an E. coli or similar outbreak, we want to be able to pinpoint it, share the data specifically around that. That's a very good use case. So we work with the Hyperledger Foundation. Something called Hyperledger Fabric is an open source framework, and we've built technology on top that allows them to have that type of network where they know who everyone is. I'm Walmart, I'm Carrefour, etc. You can choose what data to share at what point in time, but when we need it, we've got that full transaction. As we've got this middle place, we're working with a number of partners who have spun up narrow markets for specific asset classes, where you have a traditional GPLP structure, where they're bringing that data of I'm an institutional investor, and we've been through the know your customer process, et cetera, on chain. But due to how the funds are set up, oftentimes for the secondary, if an LP wants to sell their slice of a fund, they need to route it through the general partner in order to get approval. You need the tax proof of what jurisdiction it's in, et cetera. Again, you want to restrict the players, but you've actually got an asset exchange happening here. Again, similar infrastructure, but what's being built on top of that is a much deeper layer of permissioning about who's playing what role and the ability to prove that I own it, now you own it. And if I go all the way, the currency example I think is wonderful. So needless to say, if you're sending pesos from Mexico and you have family in Thailand converting to Thai baht, that's not exactly a deep market. And if you're sending $100 a month in remittances back to your family who's abroad, you can be paying absolutely absurd fees, oftentimes 10, 15% of the principal you're sending, and it can take many days to arrive. You don't have the Amazon, FedEx, I know where my package is at what point in time. That's very painful as you're trying to support your family. That's a good example of we're working with a public permission network. So anyone can show up to transact here and send it. We're representing currency digitally on a public blockchain, but you have the permission side of the players who are actually transacting are money services businesses and the like, who declare who they are, prove they have the appropriate licensing, and are now interacting with each other. And we're able to get money movement across the world, cross-border, cross-currency, in 3 to 5 seconds, and we can do that in as many hops as we want. So meaning, if we take again that the idea of we can have solve for delivery versus settlement, we can hop from peso to dollar, dollar to euro, euro to baht in a single transaction and mathematically guarantee that that entire chain goes through or none of it does. And that's very, very, very powerful. When you're sending $100 a month back to your family, you want guarantee that it gets there, and you want to be able to have that happen quickly because you're trying to support your family and at a cost that's actually appropriate.
So remittances and payments are certainly a near-term use case for digital assets. We would take the view that these permissionless, open, and public blockchains are really where the innovation lies. The reason being that this is the first time in history that there is a global connected network where people can transact with one another in a completely trusted way without middlemen. And some of the killer use cases that get us really excited about digital assets are things like financial inclusion. And today, half the world's adult population does not have access to financial services. Meaning that they don't have a bank account, they can't finance a business, they can't finance an education. But all that's required to gain exposure to digital assets is really just connectivity. And so anyone, anywhere with an internet-enabled device, even a simple feature cell phone, they can SMS Bitcoin from one person to another. We actually take the view that this asset class can actually be the springboard to financial inclusion. It actually becomes accelerated in certain geographies, like Venezuela at the moment, where people are undergoing a tremendous currency crisis, and there's countless other examples of that around the world. And so this is a part of the digital currency ecosystem that we're paying a tremendous lot of attention to as our institutions. And I think when you think about how rapidly that is accelerating with another aspect of the institutional community, which is the wealth transfer that's about to undertake over the next 25 years, we're actually going to see about $68 trillion of wealth pass from the silent generation and baby boomers down to Gen X and Gen Y and millennials. And so as you think about how that money is currently postured and what that may look like as it passes down to younger generations, we certainly take the belief that digital currencies and digital assets will certainly begin to occupy a slice of those investments going forward.
Great. Terrence, I think one of the things that always comes up in this space is like the safekeeping of the assets, and certainly one of the things Fidelity is starting with their digital asset solutions is custody. Can you just talk to us a little bit more about how Fidelity is approaching this solution and why it's so reassuring?
Yeah, absolutely. So just taking a step back, what we're building at Fidelity Digital Assets is really what Fidelity is great at. Fidelity has a very strong innovation DNA. We're mixing our institutional business, taking the best practices there to be able to offer a full-service brokerage platform for institutions to be able to access the digital asset marketplace. And so when we were surveying the marketplace as part of the innovation that we're doing, there was a clear hole here. Institutions need to be serviced a certain way, and we felt like that was lacking, or we felt like we could do a really good job at doing that. And so, getting to all of these use cases that we're discussing, all of these awesome, use cases that the panelists here are mentioning, at the absolute core of that is custody. It's pure infrastructure. It's being able to secure these private keys so that you can move money very quickly and easily. And it's frankly been a problem today in the marketplace. Either it takes very long to get your assets out of cold storage, you're writing down your private key on a piece of paper or 3 pieces of paper and putting them in 3 different vault boxes and just separate locations. And so, Fidelity's noticed this as a problem, not only from a technology perspective, but also a social problem. People were afraid to go in here. People were reading the news and hearing about hacks and losing money, and we thought we could solve that. Fidelity's taking a very long-term view that at some point, many types of assets will be digitized and tokenized, and we'll have programmable securities. And so we're starting at the base layer by offering a custody platform with the end goal of being able to offer a full-service brokerage platform for many different types of digital assets.
So part of the reason I love where you're playing is, one, the reputation, two, you're well within the regulated space, so we know who you're engaging with. But if I look at how the space has evolved to date, we've really had an abuse of terms in the industry. What we call exchanges, and take your pick of the one, is often playing the role of exchange and custodian, and so they're not just an exchange as we think about in the traditional regulated sense. They're playing many other roles, which often creates a honeypot situation where they're a target for nefarious actors. And one, by separating that, but two, bringing it into the regulated sphere where it belongs, I think is a much needed step in terms of both adoption, but also just simply the soundness and safety of the system.
Absolutely, and if you think about service and an RIA that has 500 different accounts right now, there's not a service provider that can actually help them facilitate that today to get access to Bitcoin.
And that interconnectivity is not there, right? If you're a fund and you typically deal with a prime broker and you have to only deal with a qualified custodian, today you might be able to buy a stock, a bond, a commodity, et cetera, through that prime broker, but your order management system isn't equipped for Bitcoin. You can't DBP into your, brokerage account with Goldman Sachs Bitcoin at the moment. And so this entire layer of infrastructure is being built to bridge those gaps, and I think that will be a huge accelerant in terms of having institutional adoption and more capital flowing into the space.
Great. Yeah, adoption's the key, and it's interesting, all these structures that have been being built, and it was interesting for us because more than 90% of our initial orders have come from institutions that haven't owned a single digital asset, and the majority are from multi-trillion-dollar investment managers and lots of ETFs also. So we happen to show up at the right time with a small step, which is a physical commodity. For a lot of our institutional clients, it's kind of funny. They're buying the the physical commodity and getting the digital asset for free. A digital investor mentioned to me, a digital asset fund, they mentioned that they were looking at it in the opposite way. They were buying a digital asset and getting diamonds for free. But now that infrastructure is there with the custody and the exchanges, and our tokens are compatible with all of these platforms that were built with the expectation that someday institutional investors will trade in Bitcoin, we have now a investable new asset class that benefits from that entire infrastructure.
So I would challenge that. I think we've got some of the infrastructure. I think we have a long way to go on some of the others.
Absolutely.
If I make a case for one, so I as an individual, maybe I'm interested in investing in diamonds for what reason, but perhaps I'm not interested in taking currency risk. So in that case, I would like to be able to take advantage of this idea of delivery versus settlement. I can guarantee I know where the funds are. I've got the history of the asset that's enormously powerful. But if I want to buy the thing in dollars today, I can. We can go into the details of the dollar equivalents, so-called stable coins, which are enormously challenging. Perhaps I'm interested in exposure to Bitcoin alongside my exposure to diamonds. But in the event that I want to use dollars to buy an asset, that's a key piece of the infrastructure that's missing, and that's, I think we'll probably spend more time on it in a bit, but there are a number of pieces here, digital dollar being one of them, that are on the next wave of developments that are coming that are critical to continuing to expand this market.
Justin, I think one of the things that's important, particularly for an audience like SALT, is to talk about how this has shifted perception-wise by the institutional community. A few years ago, there was certainly a notion that digital assets, digital currencies, Bitcoin, et cetera, were only being used for nefarious activity, illegal activity. And the idea of a portfolio manager or a fund wanting to or being able to put exposure on to Bitcoin would just be something that they would never do just from a reputational standpoint, thinking that their limited partners might freak out about it, et cetera. And the conversations that we have today with institutions are not only are they having dedicated internal resources following the space closely, but they're actually hearing from their LPs that they want to ensure that the funds have that type of exposure on, and that they're considering this as part of the overall investment landscape and the available options to them to, chase returns and have the fund perform well. And so I think That combined with how much the regulatory framework around digital assets continues to firm up has really allowed a lot of those preconceived notions to get shrugged off. And certainly the ability for there to be derivatives today and having Bitcoin futures trading on CME alongside things like gold and all kinds of other assets that have been around for centuries is a really, really important step forward, particularly for institutions who might need to hedge out exposure or are trying to size their portfolio appropriately.
Yeah, and I think between Cormac and Michael, we have some real opportunity to see what the real demand is for this right now. So I woke up this morning. I usually check the prices first thing in the morning. Bitcoin is back over 6,000. What are you seeing in terms of institutional demand right now, and what is like the big point that seems to stick with institutional investors when you're talking about this?
Sure. So I would say that institutions have meaningfully showed up in deploying capital, certainly in the first quarter of this year. We haven't published our asset inflows for Q1 yet, but they were quite strong and also represented actually the first quarter since 2017 that several of our products had positive performance. And institutions are paying attention to that. The types of institutions that we deal with run the gamut. It's everyone from ARB funds to global macro funds, certainly folks that are comfortable investing in the tech space. But for sure, the reason that most of these investors are showing up to Bitcoin in particular is this narrative around gold and rethinking gold as a store of value, inflation hedge, and really beginning to think about digital currencies like Bitcoin as that digital store of value. We recently kicked off a campaign, hashtag Drop Gold. It's a national advertising campaign, and it really is a call to action for investors to really start thinking about their allocations. Is the pie chart that's been so well marketed to them, does that really stay true, right, in today's environment? The world we live in is a digital one, it's an electronic one. We don't really use cash the way we once did. We don't live on a gold standard. We abandoned these things, decades ago. And institutions are beginning to realize that and starting to make that rotation out of gold and into Bitcoin.
Great. Cormac, likewise, what are you seeing on the demand front from institutions? If there are numbers or names you can share, or
Yeah, well, it's been very gratifying. We only launched a week ago. We've as you know, we have a lot of institutional investors in the equity of the company also that helped us to, with pre-orders. We now have several $100 million in pre-orders. We can't actually launch. We've chosen to be regulated, and our tokens and our exchange are both regulated by the Bermuda Monetary Authority. So we can't actually transact for about one more week. But those orders have come from 19 ETFs have approved our commodity. It's a position in an ETF, so it doesn't need regulatory approval from the SEC as if it was a one-product ETF. As I mentioned, multiple trillion-dollar-plus asset managers. And as I also said, for most of them, it's their very first and only digital asset, and we think it's kind of the opening up the window for lots more things to come in. Once we now need to have a custodian for this position in a ETF that's publicly traded, so that creates the demand for the services of a Fidelity from a very large public institution.
Yeah, if I could just add, given we have clients on board today on the custody offering, we've seen a large inflow of customers or inquiries into our platform from a wide array of different types of investors. It's funny being close to Bitcoin with Michael here for 7 years or so. My thought was it would be these crypto hedge funds and very tech forward-thinking family offices, but to see some of the biggest traditional hedge funds, pension funds, endowments that not only literally filled out our contact us page on our website, but had people very smart about this means that there is something real here. And so we have a very healthy pipeline that we'll be executing on here in the next couple of months, and they're excited to talk about that.
So one thing I'd hit on is I think across the board, the diamonds, Bitcoin, these are novel asset classes that didn't exist, say, 10 years ago. Cormac, in your case, didn't exist 10 minutes ago. What we're seeing a lot of, and we'll call it early demand more traditional asset classes where it's effectively a lift and shift onto blockchain. There's some advantage, whether it's the delivery versus settlement, whether it's the appending of data so they actually know what's going on. We can go through a number of others. There we're seeing, especially in the alternative space, if we talk about pension funds and the like, who would really like to increase their exposure to these asset classes, but for whatever reason, whether it's trust in the data, whether it's the fees they provide that they're charged, et cetera, have been unable to due to their mandate. And they're looking at this, and we are working with technology partners and broker-dealers and the like, who are building platforms that say, if I can solve those problems, and a number of them are getting really good traction for existing asset classes more frequently in the alternate space right now, we can see greater allocation of funds to what are healthy asset classes today, but perhaps have significant room for growth if these kind of lower level challenges can be solved.
Great. And I guess, I mean, we can sort of generalize this conversation, right, to, we've been talking about Bitcoin, we've been talking about, diamonds as a digital asset. Let's talk about sort of tokenization in general, this lift and shift idea. I think, there are certain markets that are relatively efficient and relatively are frictionless, and then there are markets that are less efficient and maybe more frictional. What kind of interesting stuff could be coming down the pipeline in terms of tokenization that could actually give institutional investors access to either a new type of asset or, I mean, when you're buying, say, a bond, you don't necessarily particularly care if it's sort of in an Oracle database or on a blockchain or whatever. You just want to buy a AAA bond with a certain yield and that type of thing. So from a tokenization perspective, we can lift and shift all these things onto blockchain, and that may make sense. But I think from a differentiation perspective, like what can we do with digital assets, sort of like this diamond idea, that will allow investors to get access to things that they didn't have access to before, or maybe just access to it in a more efficient way?
Absolutely. So taking two different examples of folks we're working with in totally different spheres. So IBM generates plus or minus $1 billion in revenue a year through IP licensing and similar types of structures. So we have a very, very large patent portfolio that we work with partners where we're not necessarily going to build the tech ourselves on top of it, but it's valuable to somebody else to go build, and we use various structures to make it available to them. IP is a truly, to say there's no information is probably an overstatement about what's available. You generally don't know if patents exist. It's very difficult to prove that. Even if you do, you don't necessarily know who owns them, you don't know what they're tied to, you don't know where they're being used. It's a very, very opaque market today. That's a great example of where we're working with a number of partners, both to bring the patent information of who owns what, as well as the transactional side of being able to license and the terms around it so that we have that actually embedded, and now we can go out and prove it. So that, when we think about the multi-billion-dollar patent infringement work that's going on, where we have opaque licensing structures, et cetera, we can programmatically, because again, at the end of the day, a patent's all digital. There's nothing physical we have to deal with. The entirety of the thing can be represented digitally. That's quite powerful, never mind the efficiency we can have in terms of the distribution, because it's now truly digital. It's not me getting on the phone call with one of our partners to sell or the like. So that's a really, really interesting one, a purely digital asset that simply due to the vagaries of how we arrived here is a non-existent market. It's me calling folks today. And yet by bringing on visibility, the data, we can start to have the promise of being able to bring a centralized place or a decentralized place, as the case may be, where buyers and sellers have access to the same information, and then we would expect the normal kind of market structure to take over. Adjacent space, working with a partner who's doing very interesting work around moving physical goods, in this case high-end luxury goods, but going in basically reverse flows. So think Gucci or the like overproduces, and those goods are now going from New York and the like back to the Middle East to Africa. That's not a normal trade flow, because money's coming from a place where we're generally uncomfortable, we don't know where it came from, and we've got goods moving kind of reverse trade of flow. Really good example, they're tokenizing the trade finance aspect of this. They're taking the float today because they have to be that trust intermediary, but really they're in the business of moving goods. So what they're doing is they're taking the data that they've collected, they've worked with these partners for 15 years, they're appending that and saying, I know you don't know who this is, but we've been in business for 15 years, they're good credit, and they're now making that available to novel investors.
Great. So we've got about 35 seconds left. So briefly, real quick, what's exciting to you right now in, say, 2 or 3 words about the next, say, 6 months, 12 months, 18 months? Cormac.
Well, to follow on with what he was mentioning, we're also revolutionizing the diamond industry. We've brought transparency, liquidity.
Few words. We got 15 seconds. We need to go through the whole panel. So, okay, revolutionary diamond industry. Terrence.
I think a new capital formation process.
I think innovations around cryptography.
I'm excited for the existing asset classes that we're bringing novelty to, and new investors will have access.
Great. There you have it. So Cormac, Terrence, Michael, Jared, thank you very much.
Thank you.
Thank you.